I fear that my connection may be a little compromised, only because I went from cellular into Wi-Fi. So hopefully, if it's bad or if I can't see hands or whatever it is, just let me know, please. Um, so
Sounds like a normal day to me.
well, that's excellent, and it's great to have you, Justin. I see Dave Weisberger is here in the audience. Dave, an honor for you to be here, to have you joining us. We've got some special guests coming in today that we'll get to in a little while. Gene Hoffman, along with Trent, hopefully. We'll talk about Permuto Capital and the trusts and the Chia blockchain and things along those lines. Always happy to have lots of crypto centric on the show. I think it's a good day to have crypto centric people around, especially after a pretty terrible sell off over the last couple of days. It's been painful for people that are not in crypto and are much more traditional finance focused, equity focused. Um, I think the sell off in crypto over the last couple of days has not even come close to what's happened, around chips and AI, which has taken a breather. Why exactly crypto is correlating with that, I leave a little scratching of my head. You go ahead and blame it on digital asset treasury companies, DATs, and so much anger, hatred, negativity around those structures. But even that doesn't make sense in terms of where the price action has gone. Um, and I think it's not to go ahead and pull the significance away from how much price movement has happened, but I think it's also the same with regard to similarly how people are reacting to the election results. Um, you know, in New York City, New Jersey, California. I mean, those are states that Donald Trump made a dent in, or the Republicans made a dent in on the last go around. But frankly, I don't think those will ever be, at least in my lifetime, a bastion of support for conservatism. And so, the fact that the Democrats won handily, um, I don't think is such a big deal. Other races are important. Don't get me wrong, in other states, but those states, to go ahead and talk up the results, I don't think is necessarily such a
Also,
so
Prop 50 out of California, too.
yeah, yeah, that's what I meant when I said California.
Oh,
um
my
no,
mistake.
no problem. My son asked me this morning. My high school senior wants to know if I think Zoran Mamdani is going to do anything today. I said, do anything today? I said, what do you mean? He goes, like, start enacting stuff. I go, well, he's not in power yet. That doesn't happen for a little while, son. so so anyway, we'll see how it goes. I think it's just interesting. This is not a politics show, so we're not going to go deep down that rabbit hole. Um, but yesterday's sell-off was, a bit messy. We had a little bit of relief in the late morning, and then things turned around and got worse, especially in the crypto space. I will tell you. So we have a bunch of earnings out this morning. Interesting, consumer facing, businesses like McDonald's, New York Times. um, Nvidia continues to remain I'll come back to McDonald's and New York Times and some others. Nvidia continues to be just, I don't know, hot potato in a way. China's saying, no matter what, even if the U.S. allowed Nvidia to go ahead and sell chips to China, even the Blackwell chips, which Besant said, eventually when they're obsolete, we'll go ahead and sell those chips. We'll allow those chips to be sold to China. China's blocking chips from being brought in, especially in state related data centers. So, if you're banking on Nvidia because they're going to get this red carpet rolled out for it in China, now I don't think that that's the right thesis. I mean, there are other theses for Nvidia to grow. I don't think that one is going to be a winner because I think it'll be, even if it's allowed, nevertheless, it's going to be a challenge. Palantir got hit, I'd say, hardest yesterday, especially after they reported earnings that were, off the charts. Great. Stock closed down 8%, was down a little bit more than that, even at the lows on the day. we can expect just because I think it will affect the markets. I think that there is a greater chance of ending the government shutdown now that the election is over. I think both sides thought that they had played the messaging on the government shutdown correctly, and they were willing to go through the election with the government shut down. And now that that's over, that messaging effect doesn't have much of a place, and so we should be able to get to a result. The House Minority Leader Hakeem Jeffries said he's willing to walk back the ironclad deal on the Obamacare subsidies, and so we should be able to get to some result here, hopefully over the next couple of days. At the same time, since I'm talking about election results, interesting. Kalshi Poly Market, prediction markets, crushing it. October, Kalshi processing $4.4 billion of volume, Poly Market $3 billion of volume. The overwhelming amount of volume, though, does not come from election related activity. It comes from sports. And for those folks that, again, are watching the sector of financials or brokering and prediction markets and sports betting platforms and casinos and just generally brokers who will eventually broker everything a la Robinhood, this is very important in terms of these prediction markets taking market share away from sports betting markets. It's not exactly the same when it comes to the bets that you're placing in the prediction space versus a sports betting marketplace, but it's damn close and close enough, I guess, to go ahead and warrant there being a lot of volume there. And whether people are placing bets in both places or whether people are migrating away from DraftKings and FanDuel and going towards Kalshi and Poly Market, we will find out. But that revenue stream continues to grow. Let me go to Anas first. Anas, anything new from the conference? Anything in terms of overnight activity? Do we expect a rise in oil prices if the government shutdown ends? Give us the around the world according to Anas, please.
Yes, good morning, everyone. It is evening here in Abu Dhabi, and it's day 3 of Arabic. Tomorrow is the 4th day, which is the last day. The main theme remains AI, but today we are hearing a lot about what the cost is going to be, and it is literally outrageous. I mean, we are talking people, if you look at the investment needed in AI and energy to 2050, people are talking about hundreds of trillions of dollars. I just couldn't imagine the numbers. I put a lot of stuff on my Twitter feed for those who are interested in some short clips, videos, etc. It was a pleasure to see Toby Rice, who is the CEO of EQT. He's an old friend. Last time I've seen him about 12 years ago, and he was here. He spoke about natural gas. You can see a couple of clips from his talk. Basically, he is just emphasizing the role of natural gas and how to produce natural gas in a clean way, etc. Many people are just like me, very bullish on natural gas. I am bullish on LNG, but natural gas in the United States, I'm not that bullish, but a lot of people are bullish. The main issue that I felt today that is kind of different from other days is that, yes, you see policymakers, ministers, etc., talking about this bright future, the CEOs, and then you go to the technical sessions where engineers and others, basically, and scientists, PhDs, are talking, and then you can see the difficulties there. And those difficulties are not broadcasted in the media, just like what the CEOs and others are talking about. So yes, we do have limits, and all those really bullish views, probably they will be limited by the technologies and everything else. The final point is, we always talked about this retreat from climate goals. And I've been writing about this for more than 3 years. And our outlook to 2050 is based on the assumption that we have a major retreat. But what I heard yesterday, especially today, was more than amazing, which means that I'm bullish in the long term on oil and gas, and I'm now more bullish given what those guys are talking about. For example, if you look at the Norwegian fund, which is the largest fund in the world, they relaxed their conditions to invest in companies in fossil fuels. As you know, they retreated and they stopped investing in fossil fuels,
That's
and
out
now
of
they are back.
that's out of the sovereign wealth fund.
Yes,
Okay, and
yes.
were they explicit about it, or was this more of a I
No,
don't
no, no. They
know?
are explicit. This is going to be final. That's it. It's happened.
Aha.
This is big. I mean, this is seriously big. And other funds are following suit. As you know, many banks and many funds already withdrew from the. There was a coalition that related to climate change. I forgot what the name of it. That it collapsed completely. My interpretation of the fund is that they've been really looking at this for a while, but when Bill Gates came out and talked about climate change, and probably that was the trigger.
Yeah. So that was about 2 weeks ago, right? When Gates went ahead and kind of made the about face. We didn't talk about it on this show. I wonder if we will see politicians making the same moves as the folks that are in the spending seat, right?
I'm glad you mentioned this because this is my final comment, exactly what you said. So here is the problem, and you can see that in the news. As you know, now we have COP 30 in Brazil, and officials and others are all preparing to go there. Everyone was watching what would the Trump administration do, and they already decided they are going to send a very low-level delegation to Brazil. And that created a big, massive problem for European leaders. They are scared to death to go to Brazil as like the presidents of various European countries, and then they will anger Trump because Trump is going to look at it as you are supporting climate change. So the move by the Trump administration by sending a low-level delegation, it is in a sense forcing the EU to send lower delegations. So probably like a foreign minister or less, instead of sending the president of the country. So it's really a problem for them because they don't want to be bad-mouthed by Trump. To you.
I have to ask you, Anas, only because it's going to be a big deal. I think in the broader news world. So Javier Blas of Bloomberg, who is one of the oil and gas reporters, penned an opinion piece today about regime change in Venezuela and opening the oil floodgates. I mean, obviously, that story, fairy tale, has always been there. Is it there now, realistically, than ever, or is this just eating up, some press space?
A couple of things here. First of all, the build-up, the Navy build-up of the United States in the area was to protect the elections in Guyana. As you know, Venezuela basically was claiming that 2/3 of Guyana is belonged to Venezuela, and they were trying to cause problems. And then they have the elections. The government in Guyana basically is against Venezuela. So the U.S. sent the Navy there to protect those elections, and the Navy stayed there. And we've been hearing about those talks for a while now. The issue for me is not about the regime change. The issue is how long it will take to bring this oil online. And that will be
How long will it
after,
take?
yes, so
How
it will
long?
be after Trump leaves office. So it's going to take a long time.
So if you're saying what is that? If it's going to take a long time, then is it worth? Would Trump spend the necessary capital, whatever that capital is, in order to bring regime change if he's not going to be the direct beneficiary?
I think the issue is more complex than that. I mean, by focusing on oil, this is really, we've been hearing those stories about oil for a very long time. The conspiracy theories about oil are easier than others. So remember when the U.S. invaded Iraq, they said because the U.S. wanted the Iraqi oil. When it went to Kosovo, they said, well, there is something there the United States wanted. Then when it went to Afghanistan, they made up stories about natural resources and oil and gas and all that stuff. So we've been hearing those stories all along. I do not think personally, and I know this is a public space, and sometimes you don't want to say certain things. But we got to remember that there are bigger issues than oil when it comes to Venezuela. And a lot of people do not realize this. Remember that the regime in Venezuela basically went against Israel and supported Gaza and the Palestinians. This is an issue. But the bigger issue is, where is Hezbollah today? Hezbollah is in Lebanon and Venezuela. And probably I should stop here. It's better. I don't want to be in trouble.
Okay. Thank you, Anas. Appreciate that. I did want to go to Dana Koski on the market activity yesterday. I think most pronounced or highest level headline was the fact that Bitcoin did trade below 100,000 for some lucky fellow, or it has now since rebounded. There's been incredible volatility, in crypto, and then there was generally a bloodletting yesterday on chip stocks. If you watched indices, it wasn't such a particularly pronounced day. It's not like we were down 1% or more, as if that's something big across the board, right? Not every indice matched 1% drop, but nevertheless, David Nikoski, any thoughts in particular on yesterday's market movements?
Well, Bitcoin dropped below the 200-day. It's done it, plenty of times in the past, but it always recovers in 3 days. So I'll give it the 3-day wait rule. It did bounce at a very important level that's commensurate with near the June low. Overall in the market, I still sit in my path that I'm not buying semis. The extension above the 200-day on the stocks or the SMH have reached levels that we've only seen back in 21 when we were pumping 6 trillion in the market. Many of the semis are underperforming on a relative strength basis, especially the analog. Texas Instruments at 10-year relative strength lows versus the S&P. So you've been underperforming for the last 4 years dramatically versus the index. The thing that's pushing it is AI, and those stocks, those names that are involved in that, whether it's Nvidia or AMD. I'm not a buyer of them here. I did have some shorts on, using the SOX S, which is the 3 times leverage short. The one thing that I think, and I've seen some very close friends post about how the VIX is not, cranking up. I think, you have to be aware that the options trading going on in these levered ETFs do not show up in the VIX. So you have new tools to navigate the market and especially select pockets of the market. And if they don't show up in there, the usefulness of the VIX becomes less and less as more ETFs and levered, whether they're long or short, are not calculated in the VIX index. So, I think underneath there's a lot of, names that continue to break down. The last time we got the breadth below where we are now in terms of percentage of names in the S&P above the 200-day. The last time we were at this level was August 1st. Index on the S&P was at 621. It's not me making a call that we're going to 621, so I'm just letting you look at the statistical evaluation of what's happening in the market. We've seen dramatic pressure in everything outside of tech in terms of relative strength. The XLF is actually at a 52-week relative strength low versus the S&P 500. That's even your big cap names. Granted, they're making you money like Goldman and JP Morgan, but in reality, the sector as a whole is underperforming the index, and we're at literally 1-year relative strength lows. So unless I look at the market as a fish tank full of money. If you lift up one side, all the money flows to the the lower side, right? And that's what you're seeing. That's the anomaly that we're seeing in the market. We're all living history right now, believe it or not, because you don't have as many names hitting the relative strength low list. The last time you saw it was 2000. I'm not going to say this is a bubble at this time. Bubbles are always seen in hindsight, but this is the same characteristics you saw during that period. We'll see how we come out of it. Again, I'm bullish and I'm bearish, and I have the right to do so. You have a lot of areas of the market, as I've alluded to, whether it's consumer cyclical stocks, the kavas and the sweet greens, truckers, chemicals, paper and packaging. They're all getting they look like we're just not going to eat anymore. We're not going to have transports, and we're not going to put any products in paper and packaging anymore. So that's my view of the market. It still sits in that, and that hasn't changed for 9 months, 10 months when I started talking about it. Until I see a change, will I flip to be more aggressive in picking up longs in old economy? And like I said, I'm not interested in the semis overall. I think there's a time to do it, and you have to be patient.
Excellent.
That's it for me. Thank you.
Yeah, no, thank you, Dave. North Star, I'll get to you in a second. I just wanted to crossing ADP, since we don't get jobs numbers out of the government. We got private employment. The estimate for October was an add of 30,000 jobs. In fact, we got 42,000 jobs. And last month, it was a drop of 29,000 jobs. So, at least according to the ADP numbers, still relative strength in the employment market. The in terms of pre-market movers and then announcements on earnings, so the Mag 7 kind of mixed, but generally around the flat line. The bookends are Tesla up 1.2%, Nvidia down 0.7%, everything else somewhere in the middle. AMD, which reported down 4%. The stock has more than doubled this year, so take that with that. Let's see what else. Pinterest down 18%, weak revenue outlook. Supermicro down 7%. A bunch of other names that I don't necessarily follow. Certainly, a lot of stuff in the pharma, in the pharma sector that has been reporting, and you can expect there to be a lot of movement. Company called Biohaven down 44%. Clover Health, which is a health insurer, cut its guidance for the year down 20%. And I'll go ahead and call out some others. Also, wanted to go ahead and mention before I get to North Star. One of the headlines that crossed yesterday, along with the movement in Nvidia and Palantir on the day, is Michael Burry of Big Short fame, his fund Scion Asset Management. He apparently has a bearish wager through options on both Nvidia and Palantir. For those that are in the retail/meme space, I am sure that went ahead and crossed your screen. Just for percentage context, Bitcoin is down 20% off its record high just a month ago. In the stock market, that would be a bear market. Also reporting, both Simon Property Group and more importantly Vornado, on the real estate side, both reported better than expected earnings. The reason I say more importantly Vornado is one of the largest landlords for New York City commercial real estate. If you believe whatever exodus is going to happen from New York City because of Mamdani, Vornado certainly would be directly in the target zone, along with SL Green, ticker SLG, and Brookfield as well, which are all very big New York City commercial landlords. Frankly, most leases are pretty long term, so existing leases are probably not going to be broken. But to the extent that you've got vacancies, that may be your weakest spot. All right, North Star, over to you, sir.
Okay, everybody, I hope you're all doing well. Thanks for having me on the show again. It's always nice to try and spread some of this technical analysis voodoo around and try and dispel some of the negativity against it. So I just want to take you back to a year or so ago, back in October, and the pinned post on my feed on X, where I've been pointing out that well, where should I start this from? Okay, gold is a rock. Okay, gold is a rock, and you can have all sorts of views on gold, negative and positive, whatever. But it's a rock that acts as a barometer. My background is in meteorology and sort of military aviation, so the analogy is quite important to me, that it acts as a barometer for the health of the economy. Really, it's it kind of anchors the economic cycle. So that post I've got on X that went on there a year ago, it's a simple statement that shows you a whole range of assets that have moved into a bear market priced in gold. Gold is that barometer. It tells you when there's a problem. Some of these assets move into bear markets at various random times, but when they all move into a bear market price in gold at the same time, it's sending a signal to you that these signals only come along once every 20 or 30 years, and this is the fourth one in the last 100 years. I've sort of pointed this out before, that money supply, the US dollar index, CPI, PPI, currency in circulation, the equal weighted S&P, the New York Composite, the Dow Jones, the Wilshire, the Russell are all in full-on bear markets priced in gold. The S&P and the Nasdaq are transitioning into bear markets priced in gold. So when you look at the 11 sectors of the S&P, we see that communications, consumer discretionary, consumer staples, energy, financials, healthcare, industrials, materials, real estate and utilities are all in full-on major bear markets priced in gold. So that's confluence of evidence. When we do technical analysis and just look at one chart, it doesn't really tell you anything. And sometimes when you look at confluence of evidence, it doesn't really help a lot, because you end up with a sort of a 50-50 scenario where the odds are quite evenly spread. As in a weather forecast where it might rain tomorrow, it might not. But there are times when the evidence comes together in such a way that you can say that the odds are very heavily weighted one side or the other. In other words, it's going to rain all day tomorrow, there's a storm coming, and you have a high degree of certainty. If we look at a whole range of charts, this confluence of evidence becomes very, very clear. Dow Jones has broken down into a bear market pricing gold for the fourth time in 100 years. So all of this confluence of evidence is telling us something really important, and it provides a backdrop to what's happening with cryptocurrencies at the moment. Altcoins are down 50% from their highs. They're in a full-on bear market, not just priced in gold, that happened a long time ago, but priced in US dollars. Altcoins and the crypto total market cap, in fact, is in a bear market priced in gold now. It's broken down below long-term support, below the 50-week moving average, below all the technical support levels. So altcoins are in a bear market, priced in gold and priced in US dollars. What I'll say about Bitcoin is that priced in gold, it's in a bear market. In fact, when you look at the performance for the last 12 months, or sorry, I beg your pardon, 10 months, since I put that post on X, it's my pinned post, gold has moved up 50%, the stock market's up 14%, crypto total market cap is up just maybe around about 3%, and Bitcoin is close to zero, along with Ethereum. So since the point where I started talking about capital rotation and trying to get this message across, this capital rotation process is beginning. As I say, gold has massively outperformed the stock market and cryptocurrencies. And this is just the very early initial stages where everything that we've seen in precious metals has happened because gold and silver have moved up. The stock market's not crashed, the market's not rolled over. Crypto's having a tough time of it right at the moment, which might be an early sort of indicator. But the next phase for precious metals and for this capital rotation process won't be driven by gold. In fact, gold and silver will probably be continuing to correct, perhaps down to $3,000 gold and perhaps down to $35 silver or something like that. So, gold and silver need to cool off. But at the same time, the next phase of this capital rotation process comes from stock markets showing significant weakness. And I'm talking about them really sort of rolling over into a bear market. So it's just important that when
why
people are
does that?
scrabbling
I'm
around,
sorry, North Star. Why does that need to happen? Why, if gold and silver need to cool off, why does the stock market need to go down?
Okay, so this is to do with the capital rotation definition. The capital rotation definition centers around gold's outperformance versus the stock market. And in each capital rotation event, historically, the 1930s, the 1970s, and the early 2000s, each capital rotation process, which is what we're going through at the moment, led to the capital rotation event. And the event is the process whereby the stock market goes nowhere for 10 to 15 years. It did that in the 1930s, the 1970s, and the early 2000s. In order for the stock market to effectively go nowhere for 10 to 15 years, during that period of time, it has to pull back to a very large degree so that the recoveries just take you back to where you started. In the 1930 example, you had one single massive drop. In the 1970s, there were three waves of sort of declines for the stock market, ultimately ending in a drawdown of almost 50%. Then you had two 50% drawdowns in the early 2000s. So I can't tell you exactly how it's going to play out in terms of the stock market, but what I can say is that the net effect is going to be that the stock market effectively goes, when you look back in 15 years' time, you'll look back and you see the stock market has effectively gone nowhere for that period, and B, that gold and precious metals and energy and oil will have massively outperformed the stock market over that 10 to 15 year period. That's what a capital rotation event is, and that's what this confluence of evidence is telling us. So starting about a year ago, it became very clear that cryptocurrencies were not going to outperform precious metals during 2025, and I was laughed at when I said that. But now we're in that situation. As I say, gold's up 50% and Bitcoin is at zero throughout 2025. So the thesis is playing well so far. If the thesis needs to change, then all well and good. But so far, all I can say is that the capital rotation process that we forecast and that we expected is playing out in pretty much, textbook fashion when we compare it to the previous three examples in the last 100 years.
Okay, thank you for that, North Star. All right, wait, I got Eric. Why don't you go quickly? I need to get to Gene, and we got to talk about Permuto. So you go ahead, and then we'll get there.
The little comment here is regarding what North Star is saying about the stock market during a rotation event. He's right in the sense that usually there's a drawback and then slowly come back. But in this case, because we're printing so much money, there's still upwards momentum. So in real value, yes, it's maybe stable, but because we're printing so much in nominal, still goes back up. Back to you.
Excellent. That was quick and short. David Koski, you go, then we'll go to Gene.
Yeah, I agree 100% with what North Star said. However, under the covers and what you had it in the 70s, you had it during the 2003, 2009 period, energy and there's areas of the market that just don't have enough market capitalization to raise the index. So, I mean, while the index can go sideways, you will find, areas that outperform and will outperform for, 5 to 10 years. And so that's exactly what I'm looking for. What would that take? That would have to be a dollar decline. Right now we have the dollar strengthening, which is good and bad. It has, it makes our tech companies less competitive, overseas, but most overseas markets don't have tech companies, right? I mean, they Germany has SAP. So until we run out of steam, I would agree with that whole premise. But I think it will take a dollar weakening, and we'll have to go through that stage when it comes. But I would agree with the whole thought process. There are areas that will outperform. If the dollar does move down, at some point, again, I will be back in the emerging markets, which have underperformed for 16, 17 years. Korea is up exponentially versus the U.S. market this year. I mean, it's not even close. It's if you thought we were in a bull market and you look at them being up, a bull of 200 to 300%, that's essentially what you're looking at. So I agree with the whole premise that North Star covered. Thanks.
Excellent. Thank you very much. All right, folks, I got to turn to Gene because I promised him a spot on the show today to talk to us generally about Permuto Trusts and the Chia blockchain and everything that he does. Gene, you go ahead and take it away, sir.
Well, thank you, sir. And also, I would invite Trent up if you can. It's kind of the original sponsor of this idea. So,
Okay.
the Permuto Trusts are an interesting new way to look at how you invest in large cap equities. I think one of the key ideas here is that right now, today, people do not buy Microsoft for its dividend. And that's an opportunity there. Trent has always kind of felt that these large cap equities were mispriced. And so what we're doing is we're taking Microsoft and we're splitting it into a single equity that is the perpetual dividend receipt value and another equity, which is everything else. So we call that a dividend certificate and an asset certificate. And this allows you to price these independently of each other. And so, there's kind of a growing cash flow model that you would use for the dividend certificate. And today that would put Microsoft somewhere between $45 and $65 as a dividend certificate. And then the asset certificate is kind of Microsoft stock price minus that. And it makes the asset certificate pretty interesting because it allows that to be much more volatile in every direction. And there's just kind of all sorts of interesting new investment opportunities and
Let me stop you for a second.
Yeah.
This only applies to dividend yielding stocks?
Yes, we're going to focus on the kind of call it 90 top dividend yielding stocks out there.
Okay.
We are going to couple on some of the largest ones. We're going to bring some of the ones that have small dividend yields, just because we all, I think, expect companies like NVIDIA to increase their dividend over time. But the core focus is on things like Pfizer, Microsoft, Meta, Broadcom, the companies that are currently paying a real dividend yield. And
So here's the issue. So look, let me cut you off and for the audience. Try to explain this through the lens that I see it, which is through a credit lens, right? So many years ago, somebody had this idea in the credit markets to say, look, I've got two components to the yield on every piece of debt obligation. I have the risk-free rate of return that is being paid by anyone and everyone. I don't care how good your credit is. And then I've got, separate from that, I've got your credit risk. And I should be able to go ahead and separate the two and trade the two, right? And what they did in traditional finance markets is essentially create a derivative, right? And that was the credit default swap market that was started and and trades. And to go a step further, because in credit it needed to work that way first, you can go ahead and strip away the cash payments on a total return swap basis. All right, but leave that aside for a second. The reason that I think this works in credit land, so let's say I pay, I don't know, an 8% coupon on my debt. And the risk-free rate of return for US government debt is 2%. So therefore my credit spread is 6%, right? To make up the 8% total. I totally get what you're saying. And I think it's brilliant and I love it. And I don't know if anything else does this. Maybe Dave Weisberger may know more than I do if there is an instrument in the equity markets that currently does this. But the only thing is that there is no obligation, right? As in a debt obligation, as in a contractual obligation, like a debt instrument, that the company continues to go ahead and pay its dividend. Now, maybe you just go ahead and discount the dividend for the fact that it could go away. There is no obligation to continue to pay that dividend. The company could revoke it. So maybe there's a discounting mechanism, but beyond that, I think it's great. Go ahead and push
Can I
back
ask a
at me, Gene.
question since you invoked my name, David? I mean, what's the difference between this and stated perpetual preferreds that are higher in the capital stack? That doesn't change the fact that companies can decrease dividends, but you can state them and you can set covenants that are based on revenue, cash on hand, etc., which effectively gives you what you were talking about. I mean, there are people who have done that have been very, very stable, but you're right. Companies obviously always reserve the right in some certain situations to be able to change it.
Yeah, so I think there's two things here. There's a historical antecedent, which was called scores and primes, and these launched in the mid '80s to mid '90s, but they had tax issues and other issues. But those really worked quite well, actually, and it really showed an investor appetite to be able to kind of more fine-grainedly choose how you're investing. But I think the better way to think about this is, first of all, I think the way this should be thought about is that the dividend certificate is going to yield something higher than the corporate bond, because you're absolutely right that there is no contractual obligation to pay the dividend. However, in practical reality, if you look back the last 30 years, the worst case scenario for these large cap growth equities dividends was that they held them steady in 2008. And when you look at the kind of range of these, the only companies that have cut their dividend or may cut their dividend in this kind of class of large cap growth is Intel, which I think everyone saw coming, and maybe Pepsi, because we've got a activist investor there. But otherwise, what you've seen is a very consistent, ongoing growth of these dividends. Corporations, for whatever reason, are very reluctant to do anything but hold tight in the worst economic conditions, and otherwise tend to continue to increase the dividend. So, you're going to ask as an investor for an increased rate of return above like a AAA bond, but it's not considerably more, because when you look at it, it's actually a growing annuity if you look back at any of these.
So let me take something here. And by the way, Dave, nice to hear from you. Nice to see you in another life for everyone that here. Dave and I used to work across from each other during my CS days. But Dave, specifically to your point, perpetual non-cumulative preferred stock, I'd say this is very similar to that. One thing that I would say is when you're taught finance, right, you're taught two portions of value, right? You're taught the dividend value, the dividend increasing value, the dividend discount model value. And then you're taught, okay, well, above that, there's the capital return value, right? And so what we're saying is, and a lot of what we've been talking about on this spaces thus far has been, if you've got, we're all following the movement of the stock, right? Now, if we all took a step back and we said, okay, well, what's happening to the dividends underneath? The dividends underneath for a lot of these companies have increased sometimes 60, 70 straight years. And David, to your point, these are not necessarily stable. They're not an obligation. So when I think about the risk reward curve in investing, I think that investment should sit somewhere between corporate bond returns and higher than preferred equity returns, and getting into somewhere between those and equity returns. So there's a gap in between there. Another thing I'd say is our products, the DCs, will pass through qualified dividends, right? So there's a benefit received from the tax status there as well. So when you look at where it might sit, if you're looking at a Microsoft and you run a dividend discount model, you run a growing annuity model, what you would probably find is that DC should yield somewhere between 5.5% and 6.5%. Well, a 5.5% and 6.5% return, adjusted for that 20% sometimes difference in tax basis, that allows you to achieve very significant gains, somewhere close to a bond adjusted yield in the 7.5-8% range. And then all you're making the decision on in the D is, do I believe that this dividend is going to go up over time? Do I believe their operations are going to go up? Do I believe that this is going to increase over time? One of the things that we talk about, and a lot of people ask us, is dividends are out of favor. Buybacks are what people do for the company to be able to give capital back to their shareholders. Well, what's also true is they very rarely decrease their cash paid for dividends. So as buybacks occur, there is a fundamental increase to the dividend per share. And remember, because of the way that we're built in these DCs, that dividend per share flows to the holder of the DC. So although they don't have a requirement to pay a dividend, because we are a subset of holders, they would have to cut their dividend for all of their holders to impact us. I believe that, especially for the companies that we are going after, as Gene already mentioned, that has happened very rarely. That is not to say it cannot happen in the future, but that is the reason it exists where it does on the risk reward curve. I would just say, as of right now, things like Microsoft, things like Meta, things like Google, they do not trade based off of their dividend. But there's definitely value in that dividend from a credit perspective, no matter how you discount it. And then on the other side, because an AC plus a DC always equals the underlying stock, what you see on the AC side is that the value that you have to pay for the entire benefit of the upside of the stock is lessened, right? So let's say the price of the Microsoft DC is $50, you can buy that entire upside in the stock for $50 less. We call that natural leverage, right? So you're levered to the outcome of the stock, but because you paid less for it, you can actually buy more with the same dollar. And so that is why what Gene said, that implied volatility goes up, which then has a ton of impacts on the options market, et cetera, which can help in a lot of things. The other reason the DC is very interesting, in our opinion, is for Wall Street sides, there's a lot of dividend risk that comes out of creating things like auto callables and different structured finance products that we believe this will help Wall Street hedge out their risk as well. And so it fits in a lot of places fairly nicely.
So Trent and Gene, can you tell us where is this market being made? Who is it being made for? Who do you think is going to get involved in this? Traders, investors, and what's the end game here? Why are we being educated on this?
Yeah, so I like to say I think this is a new base unit of investing, right? So if we think about who's going to use it, I mentioned traders, Delta One desks that have already reached out to us about the DC. They see it as a better single stock dividend future, which obviously we have in Europe, but we don't necessarily have yet. I know the CFTC and others are working on it in the US, but this is a perpetual vehicle. So they like that. In terms of all of our everyday life, right? We've been told a lot that it's very difficult for people to beat the market or beat indexes. We believe that that's actually a issue, and that shouldn't have been told. And the reason that has been told is because we are forced to use the same tools as individual investors, as hedge funds, as these indexes. And what this allows you to do is customize your risk profile inside of any given stock, right? So let's say you're investing and you want to invest in NVIDIA. You're not necessarily convinced that the market, well, let's say you want to invest in NVIDIA and you're 25 years old. Okay, you should probably invest in the AC, right? that makes sense. You're levered to the upside. You can buy and hold, things like that. But as you get older, you probably want a little bit more income. So instead of saying, okay, I'm going to go and buy bonds, you can say, okay, I'm going to shift some of that NVIDIA from AC into DCs. So instead of holding 100% ACs and 0% DCs, you can own 90% ACs and 10% DCs, and you can start to transition out into that portfolio over time. And so one of the reasons that's really important is for wealth planning. One of the reasons it's very important is for retirement, right? So DCs and retirement obviously grow over time. If you look at Microsoft, on average, their dividend has increased 10.8% over the last 20 years. So going into retirement, you can actually buy that Microsoft dividend. It yields fairly high, but also that growth serves to hedge against inflation, which traditionally you would have to pay 6% for. Instead, with our product, you pay something like 14 basis points, similar to an ETF. And what this is doing is it's allowing you to see stocks slightly differently, right? So if you would have just invested in the dividends going up over the last 5 years, starting in June of this year, over a 5-year period, you could have actually beat the S&P 500 with Pepsi DCs, right? Because of how much the dividend payment went up. Now we can say, is that good or bad? That's debatable, but the DCs should have increased in value 95%. And so what you see is the ability to focus on a stock, to learn a stock, to focus on a sector. And you don't have to own tech just because it's tech, right? You don't have to own semis because AI is booming. You can actually go back to fundamentals and invest in a way that allows your capital to grow, but you're not to have to take unnecessary risks that you're not comfortable with. And that is all inside of betting on the right side of the stock, right? And that's why I say it's a new base unit of investing. Who can use it? We believe it's good for retail. We believe it's good for RIAs. We believe it's good for target dated funds. And there's a myriad of different people. And then on the trading side, there's arbitrage that's capable because of that 1-to-1 equals an underlying stock that looks and smells and feels a lot like an ETF. That means arbitrage investors will be present. And then on the dividend side, you allow some of that private credit money to flow in, who actually cares a lot about that dividend, but can underwrite the risk. So there's a lot of benefits here. And really, there's a little bit of something for everybody. We're trying to take these growth stocks, these large cap growth stocks, split them into two pieces, allow the people who want to buy that capital appreciation to buy those asset certificates. And then on the dividend side, allow these people who have been locked out from tech stocks, from healthcare, from energy, et cetera. On the healthcare and energy side, it's really on the AC side, on the asset appreciation side, that gets the benefit. And so each stock has a different investor base that the AC and DC brings to it. Because generally speaking, these stocks have been split into growth stocks or value stocks for a long time. So
where can we buy this, Trent?
You'll be able to buy it on just traditional New York Stock Exchange American. And then we're working hard with the SEC. Obviously, this isn't a simple tokenization. We're changing structurally how equity markets might function. So we're also working in the background to get that onto the blockchain as well. So we want these to be the first novel equities tokenized on a blockchain. And then they're also both listed on a blockchain, and they will be listed on New York Stock Exchange American so that everybody can buy it in their brokerage account, and you will be able to switch back and forth.
Is the tokenization of this important?
It
Yeah,
is.
go ahead, Gene.
Yeah. So it is very much important. The issue is when you think about what we're doing, all of the underlying corporate actions, paying dividends, voting, all passes through. That's quite expensive actually on DTC. But on the blockchain, on the Chia blockchain, we can save just in each individual trust, and just talking about like tax and listing fees, if we were to move everybody to blockchain, we'd save nearly $650,000 a year per trust. And that allows us to pass those cost savings on. It's so much cheaper to vote. It's so much cheaper to distribute the dividend. We're a partnership, so we have to issue K1s. We're paying nearly $400,000 a year to Pricewaterhouse to be able to find all the people who own it and issue them a K1. Well, on the blockchain, you can just show up and say, hey, it's January 1st, walk the chain and give me my K1. and you build that once and you don't pay for it ever again. So we're actually going to make it about a 50% cheaper from a fees basis if you actually hold your AC or DC on the Chia blockchain instead of in DTC.
Cool. All right. Listen, I by the way, just so the audience is well aware, I have no involvement in this project at all. Gene and Trent were referred to me by one of our regular listeners on the program. I said, sure, I'd be happy to have them up and listen to what they have to say. It certainly was an education, even beyond just the product. So I appreciate their attendance and sharing with us. And for those that joined us today, simply because they're interested in the project, feel free to join us on an ongoing basis. You're more than welcome. And Gene and Trent, thank you very much for the education. Really appreciate it. I do think it is an interesting idea in today's marketplace where we're talking about stock market growth on a yearly basis of 20% plus. This may not be the most compelling investment, but for those of us that have seen darker days and have not always been accustomed to doubles and triples and things that you own, this is an incredibly I think an important product. So thank you very much for educating. I did want to go ahead and get back to normal news. On the government shutdown, I haven't flown at all during the shutdown, so I don't know exactly what's going on at the airports. I've seen a bunch of horrible images in Houston of very long lines, but our transportation secretary has come out and said that airlines are going to have a difficult time, and the CEOs of those airlines are saying the same. Again, we don't know if the shutdown will end shortly, but it's starting to get difficult for the airlines to go ahead and operate on a regular schedule. Dave Weisberger, I'm sorry, your hand was up.
Yeah, I was just going to say, I actually, because of conferences and whatnot, I've had 6 flights from Miami to either DC or New York in the last 2 weeks. And frankly, probably the best on-time performance that I've experienced in a burst of flights. Only one of them had an LA sitting on the ground. Everything else was effectively on, which I'm attributing to the fact that that's where the actual people in Congress are. Those are the kinds of flights that they're using, and so they get prioritized. But it was pretty easy. But talking to TSA agents, I mean, they're not getting paid, and they're starting to get grumpy. So those who are smart, like I think I'm pretty smart about these sorts of things. We're very nice to them and don't complain and whatever. But I think that it is, if it goes on too much longer, it will become an enormous problem. But I strongly suspect, and just to be clear, because this isn't conspiracy theories. This is the Democrats got what they wanted. They got their elections in 3 huge ones for them in their strongholds, in the only places in the country that are actually blaming the Republicans are the places where they won. I think you're going to see movement will be done within a week. And I suspect that a large amount of the market action is more closely aligned to the shutdown than people think. And we'll see. I completely disagree with Northman, by the way, on the macro side, but I have that argument every Monday with Mike McGlone, who agrees with Northman. I think when you start, and we could go back to that, and if you want me to talk about it, I will. But what I will make the point is that valuing things in gold and not caring about what's happening in money supply and government deficits and debasement of the currency, if you use charts, ignore the changes, currency printed and government spending, you're going to come out with completely incorrect conclusions. And the notion that gold will drop from 4,000 to 3,000, I'd love to make a bet on that one, because that's in nominal dollars. I mean, they may very well in current dollars. It might not keep. It may go through a period. I actually called for a consolidation period here, but people forget that the push to 3,000 and beyond was mostly central bank buying. That's not going to reverse anything. In fact, if anything, they're not going to sell. Whether they keep buying doesn't matter. But the push from mid threes or whatever threes up to 4,300 was hot, kind of CFD driven massive demand from people who actually kind of get the joke. Now that might rotate towards Bitcoin, but in fact, we'll probably move around. But the truth is that selling gold is essentially buying fiat, and fiat is problematic on a nominal basis, on a real basis, when you're continuing to run $2 trillion deficits in this country, worse relative to GDP throughout most of Europe and Japan. And unfortunately, when you look at charts and you ignore a fundamental shift, you're going to end up you're building your basis on quicksand as opposed to on terra firma. So it really it disturbs me when people don't understand that we're quite literally have added 40% to the money supply in the last 5 years, and then you're going back 5 years on a chart and ignoring that. I mean, it's literally it's just the math makes my head hurt because you're ignoring math. And oh, by the way, even the CBO says 8 to 10% growth per year of money supply over the next decade. And so with that, making assumptions, you really have to look at it that way. And by the way, the stock market sees this too, right? It's all financialized. It's about in real terms, as he said, the stock market net hasn't done very much. The companies that have outperformed, and the most of it is underperformed. And there's all sorts of reasons for that. But I just have a huge problem with chartists who ignore the base layer. So sorry. And one last point, because I know you're going to wrap up. As far as the project that Trent and those guys were talking about, I mean, Trent's a good guy, and I don't know anything about the Chia blockchain, so I'm not for it or against it. But what I will say is they're like the fifth project that I know of that have made the point that going to blockchain backends for funds and trusts is between 50 and 60% cheaper, and that's with current rules. With the rules the SEC is looking to try to implement, that number can go to 75, 80% cheaper. And if you think that that's not going to be where the puck is going in understanding financial products, well, then you're not really paying attention, because we have 3 years of at least of this SEC, and they're looking to try to streamline the processes to actually achieve these efficiencies. And so whether this particular project is the one or not, understand that it is, they're just one of the first ones, but there will be many, many more.
All around super duper, Dave. Thank you very much for those comments, both on the critique of the chartists, and then also on the foresight on the digitization of all of our financial assets. I agree wholeheartedly. Um, Let me get to Evan. Evan, good morning. Thanks for joining. Happy to have you. Thoughts?
Yeah, appreciate you having me on. Yeah, so a couple of things, a lot of good points. I mean, I'm a big kind of technical analyst guy, and the first thing when I look at, I like to look at gold versus S&P 500. I like to look at Bitcoin versus S&P 500, because obviously if you can't outperform the S&P 500, what's the point? That's the very, very, very hard thing to outperform. I know somebody mentioned what's interesting too, Korean markets have been doing pretty well this year. Japanese markets as well. I think this was, what was it, this or last year, the Japanese stock market made the first all-time high in like 35 years, which is crazy. And that's actually outperformed the S&P 500 since 2021. Don't go all crazy with that. Who knows what will happen with that? But the thing I've been looking at right now is on big points. If you look at gold, the first thing I'll say is gold versus S&P 500. Well, technically, you're still a bit below the COVID jump for gold versus S&P 500, and I would still lean towards a more bullish S&P 500 until you can break up the area for gold. So I know they talked about like 10 to 15 year theory, gold outperforming S&P 500. I don't want to put words in anybody's mouth, but it was something along those lines. And I think that if you look at the last 2 decades, that gold, really outperformed the S&P 500 is the 1970s. Then you had 20 years of like gold bleeding badly against S&P 500. And then from 2000 to 2010, I believe the S&P 500 bled almost 90% against gold. Even Berkshire Hathaway during that 10-year period bled 80% against gold, which is pretty crazy. So if you're looking at that perspective, you got a couple more years before gold really breaks away from everything, and potentially the 2030s would amount to that big run up for gold against S&P 500. I would assume with Trump in, and assuming the way things are going, they would do everything they can to kind of avoid that so soon. So I don't think gold would go down to 3,000. I'm looking at 3,200 I think that's a 20 to 30% correction. I'd be pretty surprised if gold corrects more than 30%. So I would say S&P 500 shot here. The thing that I've been looking at, I know I sound 100, like I'm 100 years old talking about it, but Berkshire Hathaway versus S&P 500 down about 30% versus S&P 500. Almost every time in its history when it's ever come down that much against S&P 500, it's jumped a lot against it. It's currently down against the triple Q right now. Had a nice bounce recently, about 33% down against the triple Q. What's interesting is when you really look hard and you try to find something that outperformed Bitcoin, outperformed S&P 500, outperformed NASDAQ, and even outperformed gold in both 2014, 2018, 2022, all the bear market years for Bitcoin. The only major thing that people know about that I could find was Berkshire Hathaway. So history tends to rhyme, not repeat. So that's one thing that I've been looking at, potentially repeating something similar to 2022. When you look at Bitcoin versus S&P 500, it looks pretty bad versus S&P 500. I think it's likely that Bitcoin does bleed against S&P 500 for probably the first half of 2026. What's interesting is S&P Bitcoin peaked out against S&P 500 in I think April or March of 2021, and then it's since July of this year Bitcoin has bled against the S&P 500. So I would assume, probably 6 more months of that bleeding there. The last thing I'll say here is in the short term, from a technical analysis perspective, Bitcoin has just broken back above the 50-week moving average, which is a really big area. And the big area that I think you'll probably definitely retest for Bitcoin, maybe this month, maybe even next month, is 108K. And if you can back above there, then theoretically your bull run is back on. But my guess, based on history, based on the way things are going, based on how overheated everything is, including the NASDAQ. And Michael Burry's been wrong so much lately, but I think he might be onto something with Palantir and NVIDIA. I think it's going to rhyme something with 2022 where Palantir may look, I think that could have a big correction in 2026, but who knows? I'm a little shaky because it seems like Michael Burry's gotten everything wrong in the past so many years. So a little shaky on that. But when you look at that, I do think those things will kind of correct into 2026. And I think big tech is very overheated. We could be getting close to the tops for the NASDAQ and a lot of those things. And I think, the last thing I'll say real quick here is that the last time the Fed ended QT, you had about a 4 to 6 month bear market. It was kind of a bear market for crypto in general from August of 2019 into the COVID lows. So if it's like 6 to 8 months, then we would go into a bear market for crypto for probably the first half of next year, which would make a lot of sense in that scenario. And I can see the NASDAQ correcting a bit as well. Probably not as bad as 2022, but probably down a bit. So yeah.
Well, thank you for that, Evan. I appreciate that. Just quickly, my thoughts. I don't know if Warren Buffett has ever thought of himself as a technical analyst. I think he outperformed because of his fundamentals, because of his discipline, and because of the cash that he has on the sidelines to become the only investor when there is no investor, or the lender of last resort in a lot of situations. So it's curious to me, to try to go ahead and put a technical analysis on something that is so fundamental. I don't think anyone at Berkshire would say we do anything technical. I think it's much more fundamental. And,
You're
a
lying.
lot. Good.
I'm kidding. I said they're lying. I'm kidding.
Okay. And the other thing, I'm a fundamental guy. That's the world I come from. That's just my makeup and my philosophy. When people talk about technicals and charts, and especially the way you spoke about it, and this is not a knock. It sounds like a video game. We've seen this before. This is the way the lines move. This is the way it's going to move again. To me, it's just me. Okay. And my audience has seen and heard, thankfully, because I'm an even-handed guy, has heard both sides of this. And at the end of the day, and I always say this, the winner is the guy who makes the most money. I don't care if you made it, as long as you made it legally, because ending up in jail is no consolation. As long as you made it legally, it doesn't matter to me if you made it from genius, you made it from sheer dumb luck, or anything in between. It doesn't matter. But nevertheless, for people that are fundamentally driven, a lot of that talk, sometimes doesn't resonate. Certainly, I keep my eyes on it. Certainly, I am aware of it. And thankfully, we get a healthy dose of it every day here on this show because of the people that we invite to speak. But that's my hot take on it. Dave Weisberger to you, then to Eric, then we'll close up. Go ahead.
Yeah, I mean, there were a couple things there. First of all, when you're talking about the S versus gold, it is so important that to do that chart without looking at corporate earnings on the same, actually normalizing divided by GDP is problematic. So Robert, who is often on your show, actually you're there, Robert. I don't want to take credit for your work, but the fact that the S&P has moved in lockstep with corporate profits, outperforming as a percentage of GDP is why the S&P has had performance or outperformance, et cetera, over time. And in fact, this quarter, I think I heard yesterday, it's almost in record territory in terms of percentage of companies reporting that are outperforming. I think it's like 80% outperforming estimates, which that's going to drive stock market performance in real terms and adjusted for nominal GDP, which of course that in and of itself needs to be adjusted by the amount of money creation. Gold is simply going to do effectively, represent two things. One, mostly is just that money creation, and two is sentiment around future money creation. And you've seen that, and gold, of course, has been taken over by momentum trading like everything else has. So it got a little bit ahead of itself, et cetera, et cetera. So I think it's really important to normalize all of this stuff, as I said before. When you start talking about things like 6 to 8 month bear markets and talking about past cycles, I once again my head hurts. First of all, altcoins have been effectively in a 6 month bear market already. So you're asking for a 12-month bear market, and frankly, there are a lot of altcoins I think that should be zero. So I get very bemused of that. You've had multiple things that have gone on in the markets, like Ethereum. I don't know where Ethereum would be today if Tom Lee decided to go out and buy absolute crap tons of it and be the face and the cheerleader for Ethereum. It was below 2,000. It was like 1,600 before he got in. It rallied all the way almost to 5,000. Is now back, kind of the midpoint of that range. Which, from a technical perspective, you probably look at and say, okay, great, it's corrected exactly what you would expect it to, given what happened. But that changes a lot. And when you compare 22 to now, I mean, the difference was they stopped QT, but the truth is they were in the middle of an interest rate raising cycle. Now, whether Powell pauses for a month or two, is there anybody on this panel who thinks that interest rates 18 months from now aren't going to be substantively lower than they are today based on a new Fed chair and an administration that believes we need to grow, baby, grow? That's really the question. And markets are a discounting mechanism. So, my suspicion is once the government shutdown ends, you'll see a little bit more speculative favor in the economy, into whether it's Bitcoin or gold or whatever. I don't know where it will go, but it will be there. Right now, there's just a lot of uncertainty, and there are actually people who think that, well, there's going to be less spending and less money created because of the shutdown and because it's going to continue. And I think that's highly unlikely. But I do think it's important when you talk about gold versus stocks, you have to look at earnings because earnings are literally what's going on here.
All right, we're going to go to Eric, but before Eric, just letting you know, we're solidly above 100 on the Dixie, 30-year at 4.7, 10-year above 4.1. Eric, your turn, and we'll close it out.
Okay, thank you, David. So I agree with David in the sense that what matters is how much your portfolio has grown. However, a little bit unlike David, more like Danish, I do think that ethics matter in what I invest in. That's a personal preference. And so sometimes there are gray zones. Like you take Microsoft, Palantir, how gray, how dark gray, light gray they are, military contract, normal contract. Yeah, so sometimes it's not really super easy to distinguish. But if I see it going through a dark gray, I'll stay away from it. That's it, David.
No problem. That's a philosophical thing. Point well taken. All right, folks, we're going to go ahead and sign off for today. We will see you tomorrow morning, Thursday already. Wow. 8 a.m. Thank you, everyone, for joining. Trent and Jean, thank you for coming on today. Evan, thanks for joining us. As always, the best speakers up on my stage. Oh, and Dave, good to see you today as well. All right, guys. See you tomorrow, 8 a.m. Have a great day. We will see you tomorrow morning, Thursday already. Wow. 8 a.m. Thank you, everyone, for joining. Trent and Jean, thank you for coming on today. Evan, thanks for joining us. As always, the best speakers up on my stage. Oh, and Dave, good to see you today as well. All right, guys. See you tomorrow, 8 a.m. Have a great day.